Good morning, everyone. Hold on, I'm echoing everyone. Technical difficulties. Yeah, my computer has decided that it hates Zoom and we had to get codes and all sorts of stuff. So I have the association one here, and obviously you all are with me now. So I actually have some of my bookkeepers with me so that we can use this as a refresher and also like a training for what we're going to be doing. So I have a PowerPoint presentation that I've used before for training and for a Facebook Live that I'm going to go over. And then I also have the, the test drive for QuickBooks account open to go over a couple different scenarios as well. So let me share my screen with y'all. This one, sound. All right. Okay. So this one, the main thing that I did with this was, are you making money or do you have a loss? And that's mostly because that's one of the questions that we get all the time. It never fails. And that's what I wanted to go over with you. So, all right. A little bit about us. You already know a little bit about us. We're no longer BBP. Like I said, this is something I used before, but we're no longer BBP. We're now officially just Top Shelf, and we specialize in job costing and complex reporting. Our niche is actually job costing. So with job costing comes 4 different industries that we primarily work with, and that's real estate, construction, oil and gas, and cannabis. So here's kind of a basic and a rundown when it comes to your financial statement. So for those of you that are asked by your bank, what is, or to produce financial statements for maybe a loan or something like that, this is what they're asking for: an income statement, a balance sheet, and most times they don't really ask for the statement of cash flow, but I put that on here just so that you'll know what that means. So the income statement can also be called a profit and loss or a P&L. And the short version of that is that tells you for a very, very, very specific period of time. So let's say that it's January through July 31st because we're in August now, or maybe they want 2022. You have to pull it for a specific date range, and that is going to tell you the sales, the expense, and the profit for that specific period of time. Now the balance sheet, the easy way of saying that is, where did the money come from and how was it used? And I'm going to go over this here in a little bit, because one of the questions that we get all the time is, my profit says this and my bank account says this. What happened to the money? Well, your balance sheet is what has loans, car payments, your sales tax, any payroll taxes. It has all of that stuff, but it also has where you as the owner, if you take money out for personal use, it goes into your equity account. So none of those payments and none of those personal draws or expenses actually hit your income statement, and it doesn't affect your bottom line. It actually doesn't even count towards your bottom line. And then the cash flow is, how is your cash generated and how is it used up? The main thing here is this income statement is for that very specific period of time. And your balance sheet is literally like your check register. It consistently rolls. So that way, if at the end of July, let's say you had $1,000 in your bank account, you're going to start August with $1,000. That's what your balance sheet is going to show. Your profit and loss, on the other hand, is not going to show that unless you pick that specific period of time. So that's why it's important to know the difference. All right. So this is an income statement. We took this from, these images are completely arbitrary. There's nothing here that's actual real numbers. It's just so that way we can go through this. So on your income statement, your profit and loss, above the line, that's another, this is like its own different language, honestly. Above the line pretty much means your income and your cost of goods sold and your gross profits. So that's everything above. That's everything directly related to what it takes for you to produce your service or your products, and then what you sell it for. Everything else after that is all operating expenses and consumables and things that don't really factor into the actual sell. So again, above the line. So what is on this? Part of this, we have our sales, like what we talked about. This is your income. This is whether you do a service. This is for sale of products, like maybe you actually produce a tangible item. Maybe it's the discounts that you put in there. Maybe you had to give back some refunds. All of that is going to go against your sales. That's another way of looking at that is how much product or services did the company deliver to the customer? And this is very, very important. And I'll get into that here just a little bit. So one thing to remember here is revenue is not the same as cash, not even close. So the reason why I say that is, sorry, excuse me, most of us have to have, we have to charge sales tax. So if you charge somebody $1,000 and sales tax is 8% on top of that, that means that whenever they pay you, your customer pays you, they're going to pay you $1,000 plus the 8% tax. Well, sales is only going to have that $1,000, and on your balance sheet, you're going to have the 8% sales tax over here. So they are not the same at all. Your bank account will have the total, but only your revenue, the amount that belongs to you, hits your income statement. This is extremely important. Thank you for the water. Like I said, I have everybody here. You only record revenue when the sale is delivered, regardless of when the money is paid. And this is going to make sense. Here are just a few, so just hold on to that. This also goes to the matching principle, and that's matching the cost of sale with the revenue, because you can't have a cost of goods sold unless you have a sold. So what I mean by that, we're going to take subscription revenue. All of us have one of these in whatever fashion that may be. So some of us will pay for the whole year, right? So let's say that we're going to use very simple numbers right now. So let's say that we pay $120 towards one of these subscriptions, and Netflix collects that on January 1st. Great. Money left our pocket, but Netflix has $120. But that 120 is divided by 12 months. So that means that they are delivering the service to us every single month. And we only recognize, or they only recognize $10 out of that full 120. The reason for that is because we have somebody coming in. The reason for that is because, hi Cameron, is they are not delivering that service to us until the month that it occurs. So again, 120 is what you pay up front, but we get a service monthly, so that's $10 monthly. So on Netflix, what's going to happen is they're going to put off of this $120 in January, they're going to put $110 the rest of the 11 months onto the balance sheet as deferred revenue. And then from there, what's going to happen is every month they take the $10 from the balance sheet and they move it to sales. Here's why this is important. Cancellations. How many of us actually pay attention and cancel our subscriptions? Not very many. That's what people bank on. But that's why we do this, because you don't want to recognize the full amount that was received and then have to do a refund. Especially if you have a board or something like that, it can actually be seen as you're trying to mislead your stakeholders or your board or whatever that may be. The bank, that happens too. So again, now we have your cost of goods sold. So these are your ingredients. The easiest way for me to explain this is when it comes to construction. So let's say that you're building a house. So in here, you would have the lumber, concrete, windows, doors, labor, like your electricians and all your trades, electrician, HVAC, plumbing. If you have somebody that's doing additional work, like maybe landscaping, that comes into here. And that's also this also includes your crew's labor, so the direct labor. So if you have a tile guy, if you have a sheetrock guy, if you have a roofer, if you have day laborers or contract labor, all of that fits into your cost of goods sold because those are all directly related to what it is that you are doing. Now, here's another example. I use the food industry. Usually, let's pick a golf cart. What are they called? The bev cart? The beverage cart, right? So you're on the golf course and they drive around and they come up to you and you decide, you know what, I want to get a sandwich, a bag of chips, and a beer. Cool, whatever. So the cost of goods sold, the actual raw materials that you bought them as raw materials, and then you had to modify them to produce this sandwich, that is cost of goods sold as far as your raw materials, because you had to take one item, manipulate it, and that produced the sandwich, and you produced a completely different product than what you originally used. That ingredient changed and it made this one product over here. That's raw materials. Now the bag of chips, they just bought a box from Sam's Club or whatever it was, and you just purchased that bag of chips. They did not alter that. The same with the beer. They purchased that in bulk and you bought that. Nothing changed. They did not change that item. Those are purchases for resale. So, thank you for bearing with me. That is the difference between raw materials and a purchase. So what is not cost of goods sold? Everything that's indirect, your admin. So if you have a secretary, a receptionist, if you have an office manager is different than a crew manager, or maybe a site manager, construction manager, whatever that may be. Admin salaries can also include your accounting department, maybe HR. Those are a lot of different things that they are necessary, but they are not directly related to what it is that you sell. Printer paper, utilities, continuing education, none of that stuff, rent, none of that counts towards cost of goods sold. It's all operating expenses. All right, so your gross margin, really, really easy. This is the money that I brought in. This is what it cost me to actually produce. And this is what I have left over. Now, after that, I need to move my people. There we go. After that, that's what you have left over to pay for your advertising, to pay for your payroll, to pay for your rent, to pay for all of these things. Now, the higher the price, you reduce your cost, that gives you a higher profit margin. That boosts your margin and that gives you more to pay all of your operating expenses down here. If you lower your price and you increase your cost, or if that's just happening organically, that means you're going to have a lower profit margin, and that is going to, or lower profit, and that's going to reduce your margin. So you see the difference? Really what it comes down to is you want to have a lower cost than what you're bringing in. Otherwise, you're going to always end up with a loss. Now, below the line, this is everything on operating expenses. So this is all of the things that it takes to run your company, but not necessarily related to what it takes to actually produce what you're selling. So this is, like I said, below the line, and those are your operating costs. These are your not ingredients and your overhead. And this is everything that is associated with what it takes to run your actual business. So sometimes if it's a very formal report, you might hear this as general and admin, or SG&A. And so that's really what that comes down to. So selling expenses. Okay, do you have a salesman that actually goes out and finds leads for you and closes deals? Do you have advertising? Do you pay out commissions to any of this? Do you have referral fees? That stuff is all part of that selling. General and admin, that's your stuff like your utilities, your rent, your office supplies, and just the things that are associated with that. This also includes your upper management, your C-level or your management, and your payroll for your admin. We already talked about advertising and marketing, office supplies, rent. So that's all the stuff that kind of gets encompassed in this. And honestly, I'm looking at this and I don't really see that I included this down here. But these non-operating and other, this is something that you don't really have much control over, but it's stuff that comes in. So maybe you earn interest off of your savings account. That would go towards a non-operating and other income. Maybe you sold something, maybe somebody wrecked a vehicle and you had to have an insurance claim. All the COVID money went here. And then maybe you're paying interest on a loan or credit cards or something like that. Usually people will put that down into other. Some people have that in the operating expenses. It just depends on what you choose to do with your CPA. And then sometimes down here we have taxes that maybe a prior year tax. So maybe you got a tax notice for a payroll tax, and it's something that you don't want to have affect your regular operating expenses for the year. So you can choose to put that down here. Most of the time, people just put it up here into payroll expenses. So these areas, all of your operating expenses are usually when you are looking to either save money or to reduce costs. This is where it's the easiest to manipulate, because you can always modify your advertising marketing. You can always choose different office supplies. You can either hire or fire, depending on if you're top heavy or if you need more admin. And then rent, you always have the choice to move. So these are the types of things that you can do here. Utilities, sometimes people make me laugh because they're like, well, why, how can I adjust my utilities if I don't turn the electricity on? That's about all that you can really do there. You maybe change your phone bill, but I mean, that's really what it comes down to. Short story here, lower operating expenses equals higher profits. All right, so now what, right? So now you have this income statement. Here are your operating expenses. So you had your sales of 200,000, cost of goods sold 110, and then your gross profit is 90,000, which means you have $90,000 to run your business. Your total operating expenses, which is where that arrow was pointing to, is 48,200. So your net operating income down at the bottom is 41,800. Can you see that one right there? I don't know if you can see my mouse. So like I said, your gross profit, 90,000, operating income, I'm getting ahead of myself on this slide, is the 41,800. So time to do some math. Very, very rarely do people actually ask you for these percentages, or will you ever need these percentages? But I left them on here because there are times when somebody will come in, especially if you have C-level or management, or if somebody comes in that is familiar with these, and they'll ask for these percentages. Gross profit percentage is your gross profit, so the very top number, divided by your total revenue. Operating income percentage, your operating income divided by total revenue. That gives you an idea of how much, where your percentages is built up on. Here in my office, if my operating expenses are over 30%, that's a heavy admin month. That means that we did not do as much billable. And I'm looking at, okay, what did we have going on? Did we have an event that we all had to go to? Like a marketing event? Did we have a lot of time off? Did we have training? What happened here? Hold on one sec. So those are the types of percentages that you want to determine for yourself, is where are you at? Because quite frankly, if most of your work is going up here into your cost of goods sold and affecting your gross profit, then that means that you may have to increase your sales. If everything is down here in admin, then you need to make some decisions and do some, pretty much look at your logistics and look at where you're spending your time at is what comes out to. All right. The other part here is those percentages. You can always compare those to your competitors. All right. So these are, as you can tell, these are from 2018, but these are the Apple and the Facebook P&Ls, all public knowledge. The first time that I did this with my team, they were like, well, they only made $265,000. No, that's 265 million. And then over here, that's 55 million. So for their report, they just rounded up to what, I don't even know what you call that. They moved the comma three times. So that's why it doesn't look, it just makes it a lot easier to read. So on these ones, if you look at this, we're talking about the operating income divided by the sales. And again, here, operating income divided by the sales. Apple's operating percentage is 27%. Facebook is 45%. So this is where you can kind of get a feeling. Remember how I was talking about where's your labor and your costs being distributed? Well, over here, there's a lot of, they have higher cost of sales up here, and there's research and development, and they're selling. There's also all the products. So a bulk of what they have is up here. I mean, think about Apple. So you have the subscriptions, you have an iPad, you have the iPhone, you have the pods, you have the pens, you have all sorts of stuff, right? So they're heavy on the actual sales itself. Whereas over here in Facebook, they are, excuse me, sorry. They are heavy in research and development because they're constantly having to keep up with IT. So they may have more expenses there. That is why if you look at this tangible versus the non-tangible, tangible usually has a lower operating percentage and the non-tangible usually has a higher. So there we go. I am dying over here right now. So that's pretty much what I have on the P&L. I was going to show you all something here on QuickBooks. If I can find my mouse, hold on. There we go. Okay. So this is a sample company. One of the things that I usually have people say is, all right, I want to know what I have made from this year to last month because we're still reconciling, right? When I come in and I look at these, I want to see only the accounts that have an amount in them. And I always look at cash basis because cash is what actually cleared the bank accounts. So for this one in particular, I'm going down and I'm looking at this. And like I said, this is a sample company. So this isn't anything that we've actually touched. But I see total income right here. We have $5,000. And there's a different breakdown. So, okay, cool. We're at $5,000. Cost of goods sold is $228 and gross profit is $4,800. And then we come down into our expenses. Well, job materials, if this was me, I'd probably move this up into cost of goods sold, but that is what it is. You can't do anything about that. And then I'm also looking at payroll, and payroll is not associated with this at all. So that makes me wonder what exactly they're doing. Maybe it's a sole proprietor for whatever reason. So expenses are $3,700 and net operating income is $1,000. Miscellaneous. One thing I would highly advise you never to use a miscellaneous. It's kind of like the I don't know bucket. So put it into something so that way you can actually deduct it. But once your I don't know bucket is cleared up, you'll have a better idea of where your money is going, because right now that I don't know bucket is causing a loss down here of $1,800. So while these numbers are useful, it's all arbitrary. You don't know if this is good. You don't know if this is bad. So one of the things that I try to get my clients to look at is separate this out. Separate it out either by quarters and look at how you're doing quarter to quarter. Separate it out by your months, and you can start to see trends on when you increase, dip, whatever the case may be. Maybe you have a bigger influx in cost of materials are higher in certain months. So you know what? Maybe you purchase in bulk on the lower months. Maybe you have an influx around the holidays of your sales and stuff. So you know that you're going to have higher payroll, whatever the case may be. Maybe you have a large influx of gift cards right around the holidays, but everybody spends it in January, February. So you know that you're going to have to basically defer that revenue. So you'll get a lot of stuff in, but know that you're going to have higher sales and a higher volume in your store or in your business coming the next few months. So that's the stuff that you want to look at here. The other thing that you can do, and I don't know if this one's set up for it, you can come up here to click all dates and switch it to years. And if you run this report, if there's multiple years, it's going to be just like the months. You're going to have all of them lined out and across. And that's a way that you can tell how you've grown or maybe how you've decreased. Maybe you were growing, and then maybe you had a big year where you were having to invest. So you took a big loss, but then the next year you're back up again. So there's a lot of ways that you can interpret this, but the short version here, your income is what you brought in, cost of goods sold, what it costs to actually get out your product, and then your expense are all your operating. And never use the uncategorized or the miscellaneous. If you do, empty it out so you know where your money's going. So let's stop share right now. Cameron, I think you're the only one on with me. Did you have any questions?
No, am I the only one on with you?
Yeah, and we're recording right now.
Oh, oh, sorry, my camera's not even the right way. You're seeing me in the mirror. Hi.
How are you doing?
Well, I just wanted to get in, hop in and listen because of the business stuff. You just never know what we're missing or doing or not doing. So I was just kind of I was just listening as I was getting ready because we have office meeting on Tuesday morning. So I just listen when you guys are talking.
Oh, perfect. Okay.
Yeah.
So I know that this is going to be going out and stuff, and so we will have if there's ever any questions, or like I said, I use this to refresh my bookkeepers. It's because I know once we get off of this, they're going to ask me specific questions. But if you know of anybody that needs any training, or if they have any questions, or if there's any suggestions for the next one, just let me know.
That sounds great. I mean, I think that was super informative, just kind of learning how to read those and look at those. I mean, of course, I have Ruthie, so she does all of our stuff. And so usually if I have any questions, we'll go to her. But I mean, it's just nice to be able to see it and know for myself too.
Right? Yeah. I mean, it's always one thing to have somebody do the work for you, but if you don't know where your numbers are or what your numbers mean,
Yes.
how do you know if somebody's stealing from you?
Yeah, exactly. Yeah. Well, actually, so now that I'm thinking about it, I do have one question.
Okay.
So you know us, we're always doing something, and so we're always getting asked for P&Ls from the different lenders that we work with. And one of the things that I've kind of come across with the real estate account is that because last year's super busy year, right? And so we have money sitting in that account from last year.
Okay.
So this year started out a lot slower than what last year was. So a lot of that money from last year just carried over. Of course, I know that real estate fluctuates. So I always have a pretty big bucket sitting there just in case we have a slow year. We can continue to use that money to do what we need to do with it.
Yeah.
So this year was one of those years where it was a little bit slower. So they asked for the P&L and they only want a 2023 P&L. And it shows It's looking like it's negative, like I lost money in real estate, but it's because we used that money from last year carried over to this year, and the amount of money that I
Mhm.
actually made in this year wasn't enough to sustain our bills, but we didn't actually like lose money because we had money carried over from last year. So is there a way to make that look a little bit better? Does it make sense what I'm saying, kind of?
Yeah. So, one of the first slides I think you hopped on a little after. One of the first slides I talked about the income statement, how it's very specific to a period of time where your balance sheet is the continuous rolling over. So what's gonna, I mean, in reality, that they are correct. You earned the money last year in 2022, so you had higher sales, lower or whatever your costs were, and then you had a profit. For this specific year, the sales are not as high, this expenses may still be the same, and you have that loss. What you could do is you could produce a P&L, and there's an option, let me share my screen with you again real quick. Okay, so I am going to say this year to last month and just do total only. But in this option where it says compare to another period, say compare to the previous year,
Okay.
and you can do a dollar change or both percentage, whatever the case may be, and you can see the difference here. If you don't want to see that comparison because for whatever reason you don't like that, you can also change your date ranges up here. So it would be 2022, 12/31 or 7/31/23, and change this to years. And this will give you a different breakdown. So what I have done for some companies, especially if they're new companies, is when they want the 3 years or the 3 years of the P&L on the balance sheet, I'll do this for 3 years. So that way they have it on one report. Because like I said, for me, these numbers are fantastic, but what do they mean? Is this a good year, a bad year? Every company is different, every industry is different. So the reason why I put these on one document is so that way if someone from the bank is analyzing these, they have a couple years and they can see the trend. And that would, for your instance, that would show them we've been doing this. This just happens to be an anomaly.
Yeah. Yeah, and that's the hard thing about real estate too, because like if you look at the beginning of the year, like it's not that great, but now of course things have picked up and it's been like crazy, crazy. So my third quarter numbers are going to be amazing, amazing numbers. So it'll kind of start to look better and even out now. But the first part of that year, I was like, oh man, it looks kind of rough, but I'm like, it's just real estate. It is what it is. Like it is
Yeah.
what it is.
And that
So,
happens. Yeah, and usually the banks are pretty reasonable, especially when you just have a
mhm.
conversation with them. I mean, I've had one of those years too. We were bringing in all sorts of stuff, and desks aren't cheap, chairs aren't cheap, computers are not cheap. And when you have to purchase multiple of them, or if it's a year that you have to replace everything,
Yeah.
ugh, I hate
Yeah.
that.
Yeah. Yeah. Just these little things that you don't think about that just pop up and you're just like, I mean, I had some pretty big, I have two higher end listings right now. They're taking a little bit longer to get sold. So my advertising expenses went through the roof because
Uh-huh.
they're just taking a little bit longer to get sold, and we got to make sure that we're getting them out there and advertising them properly. And so all of a sudden I have this huge like spike in my advertising expenses, and I'm like, well, it's because they're higher end properties, they're taking longer. The
Yeah.
lower ends they sell like in a couple of weeks, so it's not that much, but now all of a sudden I have this huge spike. So it's just stuff that there's stuff out there, but
It'll work
yeah,
its way.
it works its way through. I think so. We did submit that P&L and they did make me provide an explanation, and I was like, explanation, real estate. But no, we did. I did. I gave
2023.
them a good, yeah, I gave them a good explanation and they were like, oh yeah, that makes sense. So it's fine. So it ended up being okay, but I was just like, dang, I wonder if there was a way that we could have maybe shown it a little bit better from the get
That would
go.
be the only suggestion that I have. And sometimes banks are like, what did you do? Why did you send me all of these? Like, so that way you could see that this
Yeah.
is an anomaly. This is not
Yeah.
something that's normal. So sometimes some
Yep.
banks will say, can you send them in 3 different documents? And that's fine. I mean, if they want to look at it that way, I just prefer to have it on one and send it that way, and then they can decipher it or break it down or do whatever it is they want with it.
Okay, that's a really good idea. Ruthie will be the one that actually does it, but I'm gonna tell her, hey, I was talking to Jen. And maybe next time we show the real estate, if you have to do it by like a time period, like, year to date, then maybe show what the previous couple of years have done, because in that way they can see that, yes, by the end of the year, I should be hitting these numbers. And typically I will. Like, I was actually a little worried at the beginning of the year. I was like, oh, maybe I'm not going to hit my numbers this year. But now I'm like, oh yeah, I'll probably be more this year than I was last year. You just got to hit that kind of busier season. So,
Right.
all
Yeah.
right. Well, thank you so much. I appreciate you. I'm going to get off the camera so I can finish getting ready.
You bet. I'm gonna go ahead and close this off. So I'm gonna stop the recording.